What's up guys, my name is Abir and you are watching Money Matters, where we try to take control of our finances. So in this video we will be talking about the options trading, this concept that I have learned recently, and I wanted to share it with you guys. This video is definitely nothing that you should rely on completely. I'm no financial expert, but I am basically sharing my ideas and whatever I have learned over past few months, and this way I'll try to make sure that what I'm learning, I am validating it with you guys. If you guys know it better, then make sure to leave a comment telling me if there's anything that I missed or I am making a mistake about. So without further ado, let's jump right into this video and I'll try to explain you what options trading is, how is it different than buying stocks and stuff like that, and you know, why I think options trading is one way to make good passive income apart from dividend incomes. So if you haven't already subscribed to my channel, I will request you to subscribe to my channel and like this video if you learned something new from this video. You can also ask any question in the comment section below, and without further ado, let's jump right into the video. So the stock that we will be taking a look at is Apple stock. So there are a couple of things that you need to know before you start trading options. On Robinhood, you need to be at level 2 to start trading options, and if you want to create a spread, which I will discuss in details as well in this video, then you need to be at level 3. So this is something that I wanted to be for you to be clear and prepare. So don't expect that you will be seeing all these options and this button right here when you do it at level 1. So level 1, you can't trade the options in Robinhood, but on some other brokerage you might. Anyway, so we will be using Apple stock since it's a multi-billion-dollar company. Actually, Apple is the biggest company if you talk about market cap. Just crossed $1.5 trillion in total market cap, so there's that. Now if I want to trade Apple's option, then I will go here, Apple. I'll click on the trade options and it'll take me to another page which basically is saying Apple buy call. So buy call is nothing. It basically there are 4 combinations that you can perform basically. So you can buy a call, you can buy a put, you can sell a call, and you can sell a put. So what we're gonna do here today is I'm gonna give you guys a little idea about the selling of put and buying of put option, and what it means is I'll show you and that way you'll learn it better. So say for example, and this time you want to start selling or working with options, but you don't have a lot of money, but you want to make some quick cash. So before expiration date of 26th of June, what you will do is the current price is the share price listed here. So current price of Apple is $358.98. So what selling put means is basically what you think about this company as a whole, is that you think that the company's share value, the current share value is listed below than it should be. So this is what's in options term called bullish thinking. So what bullish thinking means is you are trying you are predicting that the market will rise. So bull market is a market that rise above the current stock or share price, and the bear market is when you predict that the stock price or the share price will tank, will go down. So since you are saying that Apple should be worth more than $358.98, you're gonna sell a put. When you sell a put, you need to have a lot of money in the account. What that means is, let me show you what I mean by that. So if I say I want to sell a put here, it will ask me that on the expiration of June 26th, I will be credited $279, but at what cost? So I will be credited at $35,000 and 471, a total of 35 grand, over 35 grand. So the total, this total needs a lot of cash, right? So you need to be either depositing this much money, or you want to be trading stocks by using the spread or credit method. So we will be talking about creating passive income today with a spread method. So instead of doing this, what I want you to do is think about it. So the current price is $358.98. I think the value of Apple in this case should be higher than this. So since the value dropped today 2%, so what I think the value of Apple should be around here, 375 or 370, around this value, right? So what I'm gonna do is I'm gonna sell a put coming down here, and I'm gonna select 332. So you should be asking me, why are you going down if you think that the price will go up? So here's what's my take on it. So if you want to be a little bit on the conservative side like me, and you don't want to risk your money with the going too bullish, then you select a number where you think that the value of the stock is never gonna go this low. So obviously by going low means that you are cutting down the risk, but at the same time what you are cutting down is also the minimum credit that you will be getting. So if you go here, so 15 cents for each share, and a total of 100 shares mean $15 you will be credited to, and this credit will be directly granted to your account right away. But if you go little bullish here and you select something like 362, if you select this one, let me unselect this and select this one, then I think the price will go to 362. This is good, that I believe that it's gonna go up, and I'm making a lot more money here. I'm making $533. But what I am doing is I'm taking a big risk from the current price. The value, the difference, the delta here is a lot. So 358 and 362 is upwards of $4. So if you are 100% sure, I would still say don't go with this strategy, and what I'm showing you, go with this strategy. So this should now make sense to you that I'm cutting down my risks. So I will say the minimum value of this Apple stock at the end of June 26th will be $332.50. But at the same time, I don't want to pay or deposit 35 grand in this. So what I'm gonna do is I'm gonna create a spread, and spread is nothing but it's basically oxymoron in options term. So selling a put as well as buying a put. So what you want to do is sell a put at a higher price here and buy a put at a lower price. So say for example, I think that I should be buying it at this level. Okay, so now when I do this, I cancel this and then I review this order. You see change here. I'm now getting, instead of getting $15 which I was getting here by selling a put, now I'm making $5 only. But what I'm doing is I am only depositing a collateral of $250. So 250 minus 5 is $245 that I need to deposit before I make this this call, basically. Not a call, in options term it's called an option. So for buying this option, I basically need to deposit this much cash. So what I'm doing is the minimum loss that the minimum gain, sorry, I'll be making is $5, the minimum gain, and this is the maximum gain as well. But my maximum loss in this case is $245. So what it means is, if the price, since we are going bullish, we are saying that the price of the stock will go higher. Just to be on the conservative side, we want to say that the minimum the price will go to 332. Then the price, then it is going to be we are cutting down the risk. We are predicting that price will most likely to go up from here, but we still want to be a little conservative, and we are cutting down our risk of losing money. But the money will be a lot if we lose. It's $245. At the same time, if we were to pick two other numbers, so say for example, let me cancel this buy put, let me cancel this sell put. Now if I were to think that price will keep horizontally here, like won't go up much, won't go down much, so I'll select a sell put here and a buy put close to here. Now you see here is that you basically will be making more money. You'll be credited $102 and your collateral is still $250, so you'll be losing a very less amount. So basically you will be losing 250 minus 102, so that will be the total loss that you will have. But what is the probability of this to happen? This is very unlikely to happen, that the price will go beyond this, unless we are 100% sure. We should not take this risk. Even if I'm 100% sure, even then I won't take this risk of putting a sell option above the strike, above the current price. So this is called out of money, but that's another topic of another video, so I'll talk about that in some other video. But for now, you need to understand that if you are risking your money more in this way, the probability of the strike price to be between is to go beyond 360 is very less, and that is why you are making more money here. So in the other case, the first case that we discussed, that what I want you to do is go conservative. Select this price here for sell put, select the upper price, say for example $332, and select the buy put at maybe $330, and you will obviously be making very less money compared to what you will be making up, but you are cutting down the risk. Like I am close to 100% sure that the price of Apple stock in 2 days won't go from $358.98 to $332. If the price goes beyond this, which is your strike price for selling put, then you will lose money. You basically will lose all of this. But if the price goes up or stays up and go even further up, then obviously you're gonna make whatever is your minimum credit. So this is the basics of how you can how you can make a passive income using option and creating a spread with Robinhood. One last thing that I wanted to talk about before ending this video is one of my favorite stocks, which is SPY. It's a spider index. It's an ETF which tracks 500 of the top companies in US. So basically what you are doing is you are buying a stock which has a share in each of the 500 top 500 companies. So if you were to do the same, instead of using Apple here, you want to use Spider or SPY, then there is a fair chance that you will be practicing more. And why I say that is because every single week you will get to expire, or the expiring date of your put or buy options happens 3 times a week. So every single week you will get 3 opportunities to put your numbers in and lock down your profits. You can make more money that way. Again, for companies like Apple, Amazon, or any other big companies, those companies usually have only one expiration date every week, but with the Spider Index you can trade 3 times a month. So this is something that I think you should consider investing in this options trading. So this is something that I really wanted to show you guys, and my way of thinking is to be on the conservative side a little bit. So I think 8%, 7 to 8% is something that I'd be comfortable with. So say for example, current price of SPY is 303, then 7% of $300 is roughly about $21. So I'll go $21 below this price. I know that the price will go up, but still I want to cut the losses and I want to take less risk. Then I'll go $21 less than 303, so which will be 79. So around 279 will be my prediction, that it cannot go beyond that. So say your chance of profits increase if you go down, obviously here, but at the same time when you are buying this here, you are basically making a very less profit here. So if I were to select 0.01, then you are making only $1 here. But at the same time, I am close to 100% sure that this won't get exercised, which means that you won't be losing any money. The price of 303 won't go down below 279. If the strike price is above the share price at the date of expiration, then you are good to go. You have made the profits. So that's it. Thank you guys for watching this video. I hope you guys like this video. Make sure to hit the thumbs up button and share it with your friends. If you have any questions regarding investments or anything related to personal finance, or you want to share your story, leave me a comment and I'll get back to you that way. Thank you guys for watching, and I hope I'll see you guys in my next video. Till then, take care of yourself and people around you. Goodbye.